everyone, and welcome back. My name is Greg Furman, and this is the Forex Weekly Outlook for the week of August the 8th, 2016. Now, to begin this week's presentation, we'll start where we always do with the US dollar index, a key player in everything we trade, in stocks, in futures, commodities. Basically, the dollar affects everything we do. So it is important to understand, how the dollar index plays into this. Right now, the dollar index having a very positive correlation to the global equity markets. So we have to keep looking at the dollar index to guide us through some of our stock trading, our commodity trading, and what have you. So the first thing I want to do and talk about is after the non-farm payroll, I always look at the numbers. Now, we hear the job creation number, 255,000 jobs, I think it was, plus a slight revision upwards. But I think what we really have to look at in our Forex trading and even our stock trading, for example, is where the U6 number is. The U6 number is how we gauge the overall unemployment situation in the US. So when I look at this, you can see looking in 2016, we'll go to March, we were 9.8, we went down to 9.7, we went flat at 9.7 and again. Then in June, we actually went to 9.6. This was a positive number by the U6 number moving down. However, in July, as strong as the unemployment report looks, it may not be as good as what we think it is. Now, parts of the labor report did show signs, extended work weeks, our average hourly earnings going up, this kind of thing, which is better. But still, that U6 number has me concerned that we are still going the wrong way here. Now, these numbers are going to be heavily manipulated by particularly the Obama administration going into an election, so we can't really trust it 100%. But essentially, I guess the point that I'm making here is the unemployment report was just okay. It wasn't really bad, but it wasn't really good either. So it leaves us somewhere in the middle with our dollar index and potentially our equity markets. But basically, everything right now is about interest rates. Will the Fed hike? That is left to be seen. In my opinion, I believe that they probably will in December, and it's still mildly US dollar positive. So I'm going to use the word mildly, not overly US dollar. Now, we may see a big spike to begin the week, but that is likely to give those gains, the dollar is likely to give these gains back. So we have to be a little bit cautious. So getting into our key levels here, once we understand this is our key level right here in the dollar index. We've got 96.19, the key VantagePoint 18-day predicted moving average. Our neural index is turning higher. Our short-term indicators are turning higher. The signal that I really like here is this one, which is the medium term crossing over the long-term predicted difference. So basically, the medium term predicted difference, essentially the medium-term trend is shifting back to the upside. So that's what we're looking for, a needle in a haystack to tell us, based around this indirect crossover, which can only be found in the VantagePoint software. Quite frankly, the predicted medium-term and long-term differences are proprietary patent indicators from the software. So when I look at this, that tells me the dollar is likely to see some strength. Now, when we combine this with our trend line support, we can see we have trend line support, strong trend line support coming in just above the 95 level. That's a good thing, guys. That's a very good thing. So when we look at this, price is rising, but we need to stay above 96.19 to begin the week, and more importantly, Tuesday and Wednesday of next week, we need to keep above here if we're going to keep buying US dollars against specific currencies, the Swiss franc, the euro, the British pound, and even the yen and the CAD. So from there, the dollar index does look like it's recovering, but it is not out of the woods yet here by a long shot. So when I look at this, our individual crossovers, our short-term coming up off that trend line support looks good, but our medium and long-term crossovers are still not convinced that the dollar is going higher. So this is something we have to keep in mind. So the first couple of days, Monday and Tuesday of next week, will determine that, but there is definitely biased for further dollar strength on that very, very mixed labor report. Now, just remember the U6 number, a lot of people don't even discuss it or look at it. I actually don't look very much at the U3 number. It's just a headline number. It's a household manipulated number. The U6 is a broader unemployment situation, so I need that number to keep moving lower to show me that the U.S. economy is moving forward, and I'm not seeing that at this particular time. In my respectful opinion, the labor market in the US currently is flat. And part of the way we can see that is the Canadian labor market is in pretty rough shape under the new Liberal government. It's in horrible shape, actually. And we've had the single biggest job loss in Canada in 5 years on Friday that was announced in Canada. So that tells me too, because Canada runs off the US basically feeds off the U.S. economy, that the Canadian economy is not doing good. That's just another signal that labor market is somewhat flat here. So these are the kind of things I look at: basic fundamentals and long-term technicals. So the question is, from here, for the equity traders, can the S&P 500 benefit from this? Well, the S&P 500 will benefit as long as the market believes the Fed will not hike rates again. So the S&P is holding its ground, but we can see, which is a very important trend line, which is coming in. My trend line is now intersecting with the key VantagePoint 18-day predicted EMA at 2152. So for stocks, continuing to move higher, and right now I would gauge the US market against all of the other markets. That basically, if the US equity markets, it's the strongest equity market out there right now, and if it continues to move higher, that will boost a global risk on scenario. We're not sure if that's going to happen here yet. So for this coming week, we can see we've closed at 2176.80 on the S&P. We need to hold above 2152 because, again, the trend line comes right in. Now, our neural index, our predicted short, medium, and long-term differences all look pretty good here. The predicted MACD, not so much. The predicted RSI, we've got a check mark here. We're at 72.6. But we've been flat here along this predicted RSI for a very long time. So we either need to break above 2200 here, guys, or we're probably coming back down into this 2075 area. So that's how I'm going to leave the equities for next week, with a very mild bullish tone. Now, when I look at the European equity markets, once again, the situation looks very similar. We've got a big boost. Now, remember what I've talked about in last week's Forex Weekly Outlook, that essentially, if we are going to sell the Euro-US currency pair, the DAX 30 the German indices must be moving higher. So right now, we've got a bit of a boost from that US. You can see how how these markets are globally connected, because we can assess here that on that strong payroll number, we can see that we've got a big move in our European equity markets. So that's a very good thing for the US dollar. So we'll see how this one plays out right now for next week. But again, we come up against a very significant trend line on the DAX, and that's sitting up around the 10,500 mark. We need to break free and clear of that. We can see we connect that to our April swing highs, and we've got what appears to be a bullish index here. So if this DAX continues to move higher, shorts on Euro US, longs on US Swiss franc will definitely be in the cards. But another global indice that we have to look at in our Forex trading that I made the case for in last week's Forex Weekly Outlook, bringing those direct intermarket correlations in here, is the Nikkei. The Nikkei is very important that it recovers. If the Nikkei can recover, the dollar yen will recover. And I'm going to talk more about the dollar yen in a moment. But for now, 16,000, a very heavy support area for the Nikkei 225. If this area continues to hold, then we're buyers of dollar yen. Plain and simple. The intermarket correlation here, guys, will trump every other indicator you're using. So if we can see that the equity markets, the global equity markets, are moving higher, then we've got potentially some decent trades for next week. But my optimism on this remains guarded at this particular time, and we have a very mixed bag on this Nikkei compared to the S&P, even compared to the DAX 30. It's not showing an abundance of strength. So I would like to see a recovery above 16,500, and I would like to see the Nikkei moving to 17,000 and above for me to be comfortably buying the dollar yen pair. Now, as we come into some of our two main commodities that I look at in my Forex trading and my global trading is, of course, oil and gold. Oil has paused the downside. We've had a substantial downside move from $50 a barrel down to below 40 this week. I basically forecasted that in last week's Forex Weekly Outlook that this was going to happen, and it came to fruition. Now we've paused down here. We must break through. In order for oil to move higher here, we have to break above. Let me just correct that, excuse me. So we're going to come back up here. The VantagePoint 18-day predicted EMA 42.94. We need a clean break of this area right here. I'm going to put a little check mark there so everybody can see it. Now our neural index is good, our short-term indicators are good, and once again you can see that medium-term predicted difference crossing over the long-term predicted difference. So basically what that means here, guys, is that the medium-term trend is weakening. So we're on a strong downward move here. We're driving strong down here, but then all of a sudden you can see that medium-term predicted difference start to flatten out and turn higher, and that led to basically a new swing low here, and oil paused. So if we can continue to hold above that, then we should be able to move a little bit higher in oil. But guys, we're coming out of summer driving season. Predominantly oil is not that strong in September, October, November. I believe we're going to hold for a considerable period of time. We will be holding below $50 a barrel. Now, with that labor report this week, guys, gold is a big one here. For your gold traders here, I'm going to bring this in so everybody can see it here. We are sitting on a very significant trend line here. That's coming in at 1340. This area needs to hold in order for gold to recover. Now, the key vantage point level here, the 18-day predicted EMA at 1339, we have closed below it at 1336. Now, a lot of that has to do with the non-farm payroll number. I consider the non-farm payroll number, guys, to be noise in the market. So this is why I go to the U6 number to try and weed some of this out. So in my opinion, the labor market is flat to sideways. It's not really growing that much. So while gold may see a bit of downside this week, probably down around these swing lows around this 1300, it should probably hold. But once again, we can see here our medium term crossing over our long-term predicted difference sends gold lower right here off of this trend line. The additional indicators from VantagePoint, the predicted MACD, the predicted RSI, another big one, and again, all of that combined to a move lower on gold. So if we break through this trend line, I'm going to highlight this. I'll just clear this so everybody can see this, and I'll bring it back up. If this trend line here breaks and we continue to hold below 1339, the VantagePoint 18-day predicted EMA, that would send gold lower. Now, if these areas hold, then we can look for gold to recover. Now, I think that there's a 50% probability that gold will recover when we start looking closer at that labor report. So that's just one thing we need to look at here. But again, you know, gold has been definitely been having a decent year in 2016 compared to the absolute horrific years. It's the last couple of years. Gold has been in a very substantial downtrend off that 1800 mark, never really recovered, but it is trying. And I think there's been some very good calls here on the gold on VantagePoint, particularly in early 2016. So for now, that's our levels on gold, and we need to watch. So with that pressure, that downward pressure on gold, once again, I've talked about this, the high intermarket correlation the euro has to gold contracts. So once we put a top in here, we've got our trend line drawn in here, and this is after actually the Brexit vote. We can see that we have a strong trend line resistance coming in here. A lot of activity around the VantagePoint 18-day predicted EMA at 110.95. We've closed at 110.83. That is not ultra bearish here, guys. Do not be tricked by the so-called market wizards that are telling us that it's a no-brainer. The euro's going lower. I don't buy into that theory actually at all. The euro currency has been one of the most resilient currencies that I've ever seen, far more so than the US dollar. So when we look at this right now, I would say we probably are moving down into the lower 109 area, but make no mistake here, guys, we are range trading between the swing high off of the Brexit vote, which is at 114, and the swing low off the Brexit vote, which is down at about 109.50. Absolutely nothing has changed, guys, since the Brexit. Okay, so we look to our intermarket correlations to determine how we are going to trade the euro. We are going to trade the euro short, providing the DAX 30 continues to move higher, providing gold continues to move lower. If that doesn't happen, we're back on the long side, guys, here. And I don't think that the DAX 30 has a lot of upside potential. I think that gold has more upside potential. So that has me looking potentially to buy the Euro-US currency pair if we can get lower. But for now, I am going to run off the VantagePoint indicators. Once again, we've got our medium-term predicted difference crossing over our long-term predicted difference, telling me that the medium-term trend is shifting from up to down, just like gold. So we can see these intermarket correlations in real time. Our predicted MACD failing on the zero line. That is consistent with the DAX moving higher. It's consistent with gold moving lower. So right now, our predicted RSI could be a determining factor. If we're going to have momentum here, guys, we need this below 40. We can see that when the euro breaks below 40, when the predicted RSI breaks below 40, the predicted MACD holds below the zero line and crosses the trigger, we get a very violent move down. So that's what we're looking for here. In summer trade, I'm not convinced we're going to get that. So for next week, again, I think that we are going to continue to range trade right now between the 112 area and the 109.50. A break on either side of that will be a very aggressive move. Same thing for US Swiss franc here, guys. We've got a solid base here. One at 96.50. We've got a swing low here. Price action is absolute rising. Now, when I look for that needle in a haystack, of concern to me is the VantagePoint predicted strength indicator. Now, I have not seen it at this level in some time, and that is a concern for me for long trades here. We can see the last time we got up this high, basically we had 2 or 3 more days of strength and then we bounced lower, but ultimately we did go higher. So I think right now we might be a tad overbought here on the US Swiss franc. I would expect it to pull back. We've closed at 98.03, but you know, we're only a hair above 97.83. So for this week, 97.83, as long as we hold above that, longs are possible. We would look for a return back to our trend line resistance at 99.50. If we can break 99.50, then we will be back above parity. We will see a much bigger move on US Swiss franc. But guys, I don't expect that until probably mid to late September. Okay, so keep that in mind also. Right now, we are simply range trading. Now, as we come into the British pound US dollar, a little bit more of a tricky situation here. 132.30, we had about a 300 or 400 pip drop off the recommended trade that I suggested shorting the British pound against the Canadian dollar, which is basically the same trade as Great Britain US, but I just chose to go to the cross pair. So when I look at this right now, the British pound taking another hit here, we're probably looking at further downside. This area in here is a concern for me. We've broken through this very tight wedge formation. We've broken through this trend line. We're below 132.20, but we have to hold below 132.20, guys. Okay, we've closed at 130.70. We know we have known support at the 130.50 area. So once again, it's not just a given that this thing is going lower. We have to look at our additional indicators. It does suggest potentially we have a trending move coming here. But again, you know, I really like that position of the predicted RSI at 34.5. Case in point right here, where we broke the 40 level on the predicted RSI. We had an absolute devastating move to the downside. Now, I'm not saying we're going to get it this time, but I'm saying the markets are very repetitive. So keep it in mind right now. The bias is to the downside, basically while below 133.40, 133.30, and more importantly, the immediate term resistance, 132.20, 131.77, and 131.32. The VantagePoint 3-day predicted EMA. These are all 3 very important numbers here, guys. When I outline them individually here, our 3-day, our 8-day, and our 18-day. So basically, we've got resistance 1, resistance 2, and resistance 3. We break resistance 3, we change from short, and we go long. That's how we do it. Okay, so that's what we're looking for the British pound next week. Be careful around these swing lows. Okay, and there is a number of swing lows sitting at 130.50. Okay, once we get below 130.50, stay below 130.50, then we can probably take another crack down at the 127 area. Okay, so when we come into our dollar yen pair, the first thing we want to look at is identify our key vantage point levels. 103.26, we then have 102.38 and 101.66. 103.26 is the key level. That's the key vantage point 18-day predicted EMA, where I've just put a check mark here. 106 is our upper trend line. Our lower trend line continues to hold here, suggesting we could get a bounce. What is it going to take for the dollar yen to move higher here, guys? It is going to take gold prices moving higher. It's going to take global equity markets, specifically the Nikkei, must move higher in order for the dollar yen to move higher. So when I know that everybody has their own trading style and everything. I'm saying and I'm not suggesting anybody should change that. What I'm suggesting is you must work in intermarket correlations into your analysis. So if you're going to be a buyer of dollar yen, that indirectly means you're a buyer of global equity markets. Okay, the S&P, the Nikkei, the Hang Seng, the DAX 30, they're all tied together here. So if they're all moving up, dollar yen should be a buy, but we must clear these three levels that I've talked about. We have closed at 101.79. That is above basically only one of the three vantage point predicted moving averages. So if we can start pushing back, I believe we do have a shot at getting back towards 103.26 this week, but we need to be very cautious if and when we get there, okay? Because the primary indicators are still warning that we've got a problem. Now, when we talk about leading indicators, I'll talk about this again. There's our culprit again, our medium-term predicted difference crossing over our long-term predicted difference. And we can see that the market paused right in this area. And essentially what that means is that this medium and long-term trend is to the downside is weakening. So the medium-term predicted difference is a leading indicator that this level was going to hold, which it did. So yes, the unemployment report assisted with that, but that you can see that the VantagePoint forecasted that days before it even happened. Regardless of what the non-farm payroll number is, it warned us that we weren't going any lower than this particular swing low right here. So very impressive using those predicted differences to our advantage. So leaving dollar yen for the week, we've got our key levels. 103.26 is a potential midweek target. We will reassess at that time, but if we cannot overtake 103.26 and stay above that area, then the primary downtrend will remain in place. Okay. Now, as we come into our commodity currencies, one of my favorites is, of course, the U.S.-Canadian pair. So I talked at the beginning of the webinar, the Canadian labor report also came out on Friday, not just the U.S. non-farm payroll. The Canadian number was pretty horrific, the worst number actually in 5 years. So when we look at that number, it doesn't bode well. It basically signals that not only is Canada in rough shape, but if Canada is feeding off the U.S. economy, then the U.S. economy is maybe not doing quite that well either. So when I look at the key vantage point levels, again, it's very important that we have a starting point, 103.75, 103.97, and 130.112. Now we've closed at 131.70 above all of these key levels, but again we have a very significant trend line coming in at about the 130.20, 130.40 area. We need to break free and clear of this for this pair to be able to extend higher. I believe it will. I'm not convinced necessarily that that's going to be next week, but I think that the Canadian dollar is going to suffer from weaker commodity prices, weaker oil prices specifically. So, it leaves our bias to the upside. We just have to be very, very cautious here because this pair continues to fail around this area. Now, we have a number of different higher lows here, which helps make the case for that long. So I'm just going to zoom this in a bit here so everybody can see it a little bit better. Now we've got pretty heavy support here. Now this is not a trend line, to clarify. This is just a lot of buyers coming in at the 130 area. So as long as we hold above this 130 area, then US CAD has a real shot of going back up to this 132.50 area. But that's what it's going to take, just to clarify, okay? And once again, more importantly, I'm going to bring this back here so everybody can see it. The key vantage point level at 130.75, this is currently our immediate line in the sand. 130.75, buyers down to this area, looking for those oil prices to continue to slide lower. If oil prices rise, that could put downward pressure on this pair, but right now it looks pretty good. Okay, so, and I will point out once again too, that medium term crossing over the long term predicted difference is what sent this pair lower in the first place several weeks ago, but it held, and now you can see the medium term crossing back to the upside. This should support the long trade. Now the predicted RSI at 61.2, this is basically a trend at trend ready. So it's telling me that we are probably going to break higher. Now, case in point, you can see a break of the predicted RSI of the 60 level right here off a triple EMA, a recovering triple EMA cross, and that led from a move to 129.50 all the way up to the 132.50 area right here. So not a bad play here, guys, and it looks like it's getting ready to repeat itself. So once again, the currencies are very, very repetitive, okay? We can talk fundamentals, we can talk Fibonacci, we can talk Elliott wave, we can talk all of these different things until we eventually talk ourselves right out of a trade, okay? So we don't want to fight this one. Let it pull back a little bit to begin the week. I would expect to pull back probably around 130, 112 on Monday, Tuesday, and we can look to buy there, okay? Now, our final two commodity currencies, Aussie US and New Zealand US. Now, Aussie US, you can see we are failing off of this trend line, but we still remain predominantly bullish on the Aussie dollar. Now, our key vantage point level, once again, very important that we know these numbers here. 75.44, that's this level right here, the 18-day predicted EMA. Provided we hold above this level, longs are actually still in place. The Aussie currency doing quite well, particularly against the Aussie-New Zealand pair. Aussie-New Zealand breaking out of that range up into the 107.50, 107.60 area. So watch the Aussie-New Zealand pair very closely to help gauge whether the Aussie-US pair is going to be able to extend higher. Now, what can hurt the Aussie is those commodity prices. Again, New Zealand's has been stronger for the most part over the last several months, but the Aussie is gaining traction here. Some of the data out of Australia, not the best last week, and not even that really helped it much. So, it really hurt the Aussie much. So, biased is still up, but we need to break through this trend line. We need to get through this, 77.50 area, break free and clear of it. Our main predicted short, medium, and long-term differences look pretty good. The predicted MACD looks quite good with a crossover above the zero line. Predicted RSI, not so much. So we've got a little bit of a mixed bag here, but again, as long as we're holding above these three areas here, which you can see that we've closed the week above all of them at 76.15, even with that strong labor report, which tells me that the Aussie is still doing pretty good. But again, we've got this trend line resistance, which is going to be a problem at about the 76.80 mark is where that comes in approximately. So just be careful around that particular area for next week. Same as New Zealand, we can see New Zealand's rising up to this trend line here. Now, once again, first thing we always want to make sure is we are identifying as our main support or resistance. In this case, it's support. The 18-day predicted EMA coming in 71.30, but we're just barely closing above this. Now, once again, we can see the difference between the Aussie and the New Zealand. The Aussie is clearly the stronger of these two currencies right now, as this is getting ready to actually challenge that. It's barely holding above the VantagePoint 18-day predicted EMA. We've got this one right here, our medium-term predicted difference crossing over our long-term predicted difference here, guys. This is a major indicator for me and a very powerful indicator from the VantagePoint software. Now, our predicted MACD actually is not supportive of a downward move here, believe it or not. It's above the zero line, it's crossed the trigger to the upside, but you can see that the predicted RSI, we have a very mixed bag here. So 7130 to begin the week here is going to be the line in the sand. Watch that area very closely. If we get a sustained break of 7130, then New Zealand US is going to go considerably lower, and that would mean indirectly that Aussie New Zealand is going much higher. So, but if this holds, then you have two different trades here. You can start shorting Aussie New Zealand while you're buying New Zealand US. There's always two different trades that run off of any US major pair. So, because remember, the cross pairs are synthetic. They don't actually exist. Aussie New Zealand, there is no such thing. Aussie New Zealand is a combination of Aussie US and New Zealand US. There's actually 4 transactions there. So it's important to understand that when you're trading these things, that Aussie US and New Zealand US is being affected indirectly by the Aussie New Zealand pair. So right now, clearly the edge is longs on Aussie New Zealand, as I've said here on Trader Planet basically for weeks. So we've got a busy week ahead of us next week, but we are in summer trade here, guys. You don't want to forget that. I don't expect any real big breakout moves in the next couple of weeks, but if the market interprets the non-farm payroll differently than what I did, then the US dollar could see substantial gains going into September.